Hello everyone, welcome to today's US Open live webinar. I am your host Nikos Zabouras, Senior Market Specialist at FXCM. It is Tuesday, 1st of August, 10 minutes before Wall Street opens, our usual slot. And we have a packed session today. We have a lot to talk about. We have the Reserve Bank of Australia today holding rates steady for second straight meeting, which sent the Aussie lower. The Bank of Japan on Friday widened its yield curve control, but in an implicit way, and USD JPY rises, while China's factory activities stayed in contraction territory, and this keeps the US oil advance in check. Before we get into all of that, however, please read carefully through the risk warnings and the disclaimers, and then we will get started. Once again, please read carefully through the risk warnings and the disclaimers, and bear in mind that anything discussed here does not constitute an investment advice and should not be construed as such. Okay, let's get the ball rolling. We have a lot of things to discuss, as I already mentioned, and let's jump straight to the Australian dollar versus the US dollar, where the Reserve Bank of Australia today kept rates unchanged at 4.1%. This is the second consecutive hold and the third in this tightening cycle. It was not a surprise given that inflation moderated further in the second quarter to 6% year over year, and this has been the lowest in almost 2 years. On the other hand, policymakers once again kept the door open to more tightening, as inflation is still far from the 2 to 3% target, even though it has been coming down, and the labor market is very tight despite some cooling. Now, the pair dropped as a result. You can see on the chart today's decline, which is this area here, and the pair trades below the exponential moving 200 exponential moving average 200 period, and it is now exposed to the 0.6563 resist support, although a breach of 0.6456 seems more difficult. I'm more cautious around that. Now, the Aussie has shown resilience in the less aggressive RBA that we have been seeing recently over the last couple of months, while markets believe that the Fed has reached the terminal rate. As such, we can see a rebound above the 200 period EMA, which sits at around 0.674, but does not inspire much confidence for a sustained strength past 0.69. And the fact of the matter is that July was a bit of a mixed month. There wasn't much direction, and given the uncertain policy outlook from both central banks, we could see a continuation of that lack of direction and perhaps staying within the 0.69 on the upside and 0.6456 on the downside range. Now, let's go to the yen, the US dollar versus the yen. And the reason for that is that we had the Bank of Japan decision on Friday, maintained the 0.5% yield curve target for the 10-year yields, but will now offer to buy bonds at 1%, essentially widening the yield curve control. Now, in theory, that's a step closer towards an exit from the ultra loose policy setting, but it also allows it to maintain this policy stance, this dovish policy stance, for longer. The decision sparked volatility, but USD JPY has been gaining and moved again towards the September 2022 intervention level, which is at around 045.9. Now, we had seen verbal support back in late June when this level had been approached again, and there is risk for renewed intervention, verbal or actual eventually, which may contain the advance. At the same time, the relative strength index is close to overbought territory, as we can see a test of the 200 period EMA on the downside at around 140.8, although a catalyst would be needed for further decline that would challenge 137.22. Given the fact that the implicit nature of the BoJ tweak makes policy even more unconventional, and the uncertain outlook around the policy path from both the BoJ and the Fed, it's a bit hard to pin down the next leg of the move, but immediate bias is on the upside for now. And let's go to Euro USD. We already talked about the ECB decision in our last session. The common currency slapped after that decision and after President Lagarde opened the door to a pause in the upcoming meeting in September, as this was in the most dovish press conference of the year. Yesterday's better than expected preliminary Q2 GDP did not do much to help. It came in at 0.3% expansion, while today's poor PMIs from Germany and Eurozone weigh on the pair. This creates risk for a test of the 200 days EMA, as you can see on the chart, which is close to 1.08, but we are cautious still for a test of this support, because we also have the upward trend line from the 2022 multi-year lows. In general, we're cautious for further weakness that would test 1.0634. The current region can contain this region up to the 200 days EMA, can contain the fall from a technical perspective and give Euro USD a chance to rebound, but we struggle to see at this stage new 2023 highs. Current are at 1.1276. There is uncertainty here too, around the Fed and around the ECB, but the ECB may still have more hikes ahead as it has more ground to cover on inflation. Let's shift gears and go to US oil and talk a little bit about China's results, China's data, economic data. The poor data continue from the world's biggest importer of oil, as factory activity remained in contraction territory for the fourth straight month in July. However, authorities have pledged to take action to support consumption, private investment, and the property market. Now, the fears around China's recovery contain US oil today in this latest batch of disappointing data. And Actually, let me bring US oil on our chart, on our screens. This is it. As I said, the RSI has been diverging lower, as you can see on the bottom part of your screen. This could create a pullback below 80, but a strong catalyst could be required for the 200 period EMA at around 75 to be questioned. However, US oil comes from its best month in over a year, as China's stimulus pledge and the massive output reduction plan by Saudi Arabia, Russia, and OPEC Plus support prices and are expected to create a tighter market in this second half of the year. Now, bulls are in control and have 83.55 in their crosshair, but the next resistance at around 90.36 looks distant yet. And with already 1 minute into the US session, let's go to NAS 100, the tech-heavy index. The truth is that not much has changed around the outlook, since the index is held by optimism that the Fed, market optimism that the Fed is done hiking. Remains to be seen if that is the case. Strong economy, solid tech earnings, and of course the AI boom, which has been one of the main drivers of this year's advance. It is on track for new 2023 highs and the 16K mark, but the record highs still look like they can be elusive, at least in the near to mid term. Now, on the other hand, a pullback towards the 200 period EMA at around 15,250 would be reasonable, but anything more looks very tough under current conditions. And as always, let's wrap things up with what's ahead. It is a busy week, mostly in the second half, though. With the Bank of England and key US earnings. Today, at the top of the hour, we expect PMIs, the ones from the United States, the ones from Europe were bad earlier in the day. We already mentioned about that. And then tomorrow, we expect the Q2 employment data from New Zealand. They will be important because in a watershed moment, the Central Bank of New Zealand paused its rate hiking cycle after 12 straight increases worth 5 to 5 basis points, one of the most aggressive banks along with the Fed. And its projections suggest that the terminal rate has been reached. However, the labor market is very strong and wages high, so it will be important to see the new data. And of course, on Thursday, we have the Bank of England, which also releases its updated projections, which are also important. The bank was forced to reaccelerate the pace of tightening with a 0.5% hike in June due to high inflation and wages. The last CPI report, however, showed a moderation in core and further easing in headline, so policymakers may be less aggressive this time around, but backing down does not look like an option. Of course, we're going to have the chance to discuss about the outcome at our next session on Thursday, 10 minutes before Wall Street opens as usual. That's it from me for today. Thank you for joining me.